A dollar today is worth more than a dollar tomorrow. Why? Because today's dollar can be invested and start working for you. This is a fundamental financial concept known as the time value of money. If I gave you $100 today and you put it into a savings account earning 4% interest, in 1 year, you'd have $104. But if you wait a year before putting that $100 to work, you've lost that growth. The takeaway? The earlier you start investing, the more powerful your money becomes. This is why procrastinating on investing is so costly. Even waiting just a few years to start can mean missing out on thousands or even hundreds of thousands of dollars over a lifetime. Compound interest. This is where the magic happens, and it's the engine to your wealth-building machine. Compound interest means you earn interest not just on your original investment, but also on the interest you've already earned. Over time, it snowballs. For example, if you invest $1,000 at a 7% return and let it sit, after 10 years, it grows to almost $2,000. After 20 years, it's almost $4,000. After 40 years, it's almost $15,000. Notice how the growth explodes the longer you let it ride. That's why starting early matters. Your money is like a snowball rolling down a hill, and it gets bigger and faster with time. Inflation. Inflation is the steady rise of prices over time. You see it every time you buy groceries or fill up your gas tank. That $5 sandwich you bought in 2010 might cost you $9 or $10 today. The problem is that inflation erodes your purchasing power. If your money is just sitting in an account earning 0.01%, you're actually losing money in terms of purchasing power. This is why investing is so important. It's your best defense against inflation. Historically, the stock market has returned about 7 to 10% annually, which outpaces the average inflation rate of around 2 to 3%. So while holding all your money in cash feels safe, it's actually risky long term. Investing is how you protect your future self from rising prices. Interest. Interest is one of those financial concepts that can either build your wealth or bury you in debt. When you're earning it through investments, bonds, or even a high-yield savings account, the money is working for you. When you're paying it, like credit cards, payday loans, or high-interest car loans, it's your worst enemy. Carrying a $5,000 balance on a credit card with a 20% APR can trap you in payments for years. You could easily pay $10,000 or more just to get rid of that debt if paying the minimum. But if you invested that $5,000 instead, compounding could grow it into tens of thousands over your lifetime. Interest can be a double-edged sword, so make it your ally instead of your enemy. Diversification. This is just a fancy word for spreading your money out across different investments. The idea is simple. Don't rely on one thing to carry your wealth. Or in the words of that age-old saying, don't put all your eggs in one basket. If you put all your money into one stock and that company goes bankrupt, you're wiped out. But if that stock is just 1 out of 500 in your portfolio, the impact may be fairly minimal. Generally speaking, one of the easiest ways to diversify is through index funds or ETFs. These let you own a little piece of hundreds or even thousands of companies all at once, instantly reducing risk and giving you immediate diversification. Don't gamble on just one stock, one company, or even one industry. Spread your bets and you'll smooth out the bumps along the way. Assets and liabilities. At its core, wealth building comes down to this: collect more assets than liabilities. An asset is anything that puts money in your pocket. This could be investments, rental properties, or even a small business. A liability is anything that takes money out of your pocket. It's the student loan debt you have, car loans, or that shiny new iPhone you financed. The tricky part is that sometimes things look like assets but are really liabilities. A car, for instance, might feel like an asset because you own it, but it costs you money in gas, insurance, and depreciation every year. Ask yourself with every purchase, does this add money to my pocket or take it away? Cash flow. Cash flow is simply the money moving in and out of your life. Think of it as the heartbeat of your financial situation. Positive cash flow means more money is coming in than going out. You can use the extra to save, invest, or even pay down debt. Negative cash flow means you're spending more than you earn. This can lead to credit card debt, loans, and financial stress. Cash flow isn't just about your monthly budget, though. It's about freedom. If you can get your expenses under control and build positive cash flow, you'll have options. You could travel, start a business, invest more, simply sleep better at night, or even retire early. If you're new to learning about finances, then you'll often hear that you should spend less than you earn. It is one of the core financial behaviors to building wealth. Managing your cash flow is important for that. It's not about how much you make, it's about how much you keep and what you do with it. Recessions. Recessions sound scary, and they often feel that way when you're in one. It's a period where businesses may earn less money, people might lose or find it much harder to obtain jobs, and overall spending goes down. And the news, well, it's basically just doom and gloom. But recessions are normal. They're part of the economic cycle. Historically speaking, recessions generally happen about every 7 to 10 years, and the economy has always recovered afterwards. For investors, recessions can actually be opportunities. When stock prices fall, it's like they're going on sale. If you keep investing or even increase your investments during recessions, you could come out much stronger on the other side. You don't want to panic and sell when markets dip. You can prepare for downtimes in a number of ways. You can ensure that you decrease your overall debt burden by paying off debt as quickly as possible. You also want to build up an emergency fund. This is a pile of money that sits in an account that you can pull whenever emergencies or unforeseen circumstances, like a job loss, occur. The beauty with paying off your debt means an increase to your overall cash flow, allowing you the opportunity to use those dollars to build that emergency fund. Taxes and fees. Ben Franklin penned the famous line, "In this world, nothing can be said to be certain except death and taxes." This isn't the sexiest part of investing, but it is critical. Taxes and fees can eat into your returns big time, and most beginners overlook them. Fees are typically charged for handling your investments. If you have an actively managed fund, then the fee for that would typically be higher than a passively managed fund like a fund that tracks the S&P 500. A 1% annual fee on your investments may not sound like much, but over 30 years, it could cost you hundreds of thousands of dollars. Taxes work the same way. If you invest in a tax-advantaged account like a 401k or an IRA, you could save a fortune compared to using a taxable brokerage account. Always look for low-cost investment options and use tax-advantaged accounts whenever possible. You could even work with a financial professional like an accountant or financial advisor to best maximize your tax situation. Small percentages matter over time. Credit scores. Your credit score is like your financial reputation, wrapped up in one number. It usually ranges between 300 and 850, and it's how lenders decide if they can trust you with money should you need to borrow any. A high score, about 750 plus, means you're likely to get approved for loans with better interest rates. A low score, that means lenders see you as risky, and you'll either be denied or charged much higher interest. Your score is based on things like paying bills on time, how much of your available credit you're using, your actual utilization, how long you've had credit accounts open, your mix of credit types, and how often you apply for new credit. Over a lifetime, a good score can save you tens of thousands of dollars in lower interest rates. A bad score can hold you back from renting apartments, buying homes, or even landing certain jobs. So pay bills on time, keep your balances low, and avoid applying for credit you don't need. Understanding these basic financial concepts won't make you a millionaire overnight, but they will give you something even more important: confidence. You'll know what's happening with your money, why it matters, and how to make smart moves for the long term. Thanks so much for watching. If you found this helpful, hit that like button, subscribe, and share the video with a friend. And let me know in the comments which of these concepts you wish you'd learned sooner. We'll see you in the next one.